Hey guys, Mike here. So today we get to answer all your questions and comments, and I picked out a few good ones here. And one, of course, we had a bunch on Apple, so we'll just pick out the one for that one to explain, why it exploded on Friday and everything. Because I know some of you might have actually looked at the earnings and you're like, really? But we'll go into that and understand. Really, the question is like, why do they buy back so much stock and everything? So I think a lot of people don't realize really the real reason they do it and how it affects them and stuff. The other one, another big one was, I know a lot of people don't really understand what's going on behind the scenes at hedge funds and 401k plans that we're all paying into and stuff. And so it's a long question, but it's a really good question. I think there's things you just don't realize, right? And there's no reason you should know it, to be honest with you, right? And then there's a couple other good ones we'll get into. So feel free to participate, answer some of these questions, and contribute as well like you normally do. So let's go ahead and get started with the first one here. And it says, hey, Mike, why does Apple buy back so much stock instead of investing the money into more growth? And you might have heard they decided to announce $110 billion with a B dollar buyback. They've announced the last 5 buybacks have been record buybacks. The reason why, if we go into our Discord here and look up company earnings, is because their growth sucks. That's why. That's just being honest. I mean, look at this. Quarter over quarter total minus 24%, product minus 30%. Services saved their butt, which we'll look into that even more detail. That was a plus, right? But you see year over year, it's terrible, right? And it's terrible when you compare it to others. But when you pull it up, you can see this. If it's in the parentheses, it's negative, right? What Say doing was services. Okay, services was positive. But as far as products, things of that nature, actually negative. So not good when you compare that to stuff like, the other big ones like Amazon, right? All these are positive, plus 13% total, plus 17% for AWS, plus 11% for subscriptions, right? And so they have all this stuff going on that they are showing growth, right? And what did you hear Amazon not really talk about? Stock buybacks and stuff and dividends and stuff, right? Microsoft, they do stock buybacks, but they don't have to do as much because why? Look at the growth. 17% revenue growth, 24% for servers, gaming, plus like 51%. Like they're into all kinds of stuff, expanding out into areas that are still growing for them, right? You look over here at Google, same thing, or Alphabet, that is, the parent company, right? Plus 15% year over year growth. YouTube, plus 21%. Google search advertising plus 14%, and so plus 28% for Google Cloud. And this stat ought to blow you away, but here's what's crazy about this. Companies have been one of the biggest buyers. Since 2000, they've bought $5.5 trillion worth of stock buyback. You think about that, $5.5 trillion worth of stock back. I mean, that is an amazing number. I don't know how anybody cannot be like stunned by that number. Imagine if they invested that money, right? In a way, it is an investment. I shouldn't take that back. In a way, it is an investment. Before I get into the whole Apple thing, I understand there's 3 reasons companies buy back stocks, right? Stock buybacks help companies consolidate ownership, right? Because they're buying back the shares. When there's market pessimism, there you go. Companies use buybacks to increase equity value, i.e. Apple. And buybacks can make companies look more financially healthy, attracting more investors. Now, the important thing to understand here is, and before we continue, guys, please hit that thumbs up down there. It helps people find the video. I really appreciate that. And think about subscribing if you like these kind of videos. Apple has to buy back more shares and announce these crazy buybacks and increase dividends because you saw it yourself. The numbers don't lie, right? When you compare it to the other big boys, their growth just isn't there. They hadn't been as innovative, right? They have the iPhones, they have their iPads, they have their little goggles, which they totally overestimated their followers, and they thought they were going to pay that crazy price for it. And now they're like, oh, no, we're not going to sell half what we thought we were going to sell. Oh, how about that? Nobody's paying, was it $3,500 for those stupid goggles? I mean, that's just nuts, right? And, it's one of those things like they've bought all these AI companies, and they got an event coming up next week. So maybe they'll lay down, I keep saying the robot dog or whatever, but something like other products, right? But they've been so reliant on that iPhone and iPad, and they've built a huge following, right? Which great, but eventually you got to do something different, right? You guys are having more products that are going to bring in real revenue, not just adding little specs and making a new iPhone and a new iPad and adding some AI feature to it, but actually come up with new products to put out there. And so, that's the reason why they have to buy back so much stock. And so that's why you don't see the other ones. The other ones aren't forced to do it yet. Maybe one day Microsoft and Google, they buy back stock, but nowhere near at the pace as Apple, right? And Amazon, they decide to take their money and reinvest it, right? To try to keep the growth going because they still have growth. There will come a point in time where all those companies, they get so big because Apple is a huge company that it just gets stagnant, right? And so when that happens, you will see Amazon start announcing these just gigantic buybacks and dividends and all this stuff, but they just don't have to do it yet. Okay. And so understand when you come into earnings, and this should be, as I told the members, a valuable lesson to teach your kids, say, hey, it ain't all about growth. Growth is great, but understand the Apple method, which is we have growth, we have all this stuff, this moat, whatever, but when the growth ain't there, we'll just take all this cash we have because they're the cash king, and we'll just buy back the stock. Investors love that. We'll give them a bigger dividend. Investors, when I say investors, I mean the big boys. Wall Street love that, right? Again, it's like the heaviest weighted stock there is in pensions, and they're the most owned and stuff. So that's why they buy back a lot of stock, and I guess that will continue unless Wednesday comes out with some crazy product that's going to start generating a lot more revenue for them. All right, that's the big thing. Now, this is a longer question from Dr. Marcus, but it's a good one, and pay close attention, okay, because I guarantee you some of you didn't know this. We all know retail does not move markets, big money does. I may be way off here, and this is a generalization. Big hedge funds and institutions normally invest long term, so do boomers who hold the most wealth. We will get back to that because that is not true. They are not usually, nor should they be timing the market. They usually just DCA, buy and hold long term. So why on minimal and inconsequential short-term news do you see the big money dumps? Don't they know better than anyone to time the market, especially in long-term safe ETFs like BTI and VU? Also, I'm aware that lots of big money have to reallocate or take profit and swap here and there. Talking more about when it's clear that everyone is dumping for no good reason. And this is where I want to go into a few things. One, it is not true that hedge funds and 401k plans and institutions hold for long term. Okay, that is not true at all. And the reason why you know that, especially the active ones, is because Warren Buffett used to put a challenge out. I think he stopped it finally to any fund manager, really, especially if they're going to be active investing, that if they could beat the S&P, that he would give them $1 million. And many of them took on the challenge and they failed. All right, but the one reason is, the biggest thing is, it's the fees they charge you. Like, look at this. A lot of people don't realize this because they ain't cashed out the 401k yet or all this stuff. But look, let's go through some stats. So according to Business Insider, 88.4% of domestic actively managed equity funds underperformed their benchmark over the last 15 years. This would be true. Additionally, over 80% of large cap funds underperformed the S&P 500 over the last 5 years, right? So the performance isn't that great, but also the big thing you got to understand is they got to stay active. Why they got to stay doing stuff, right? Because they're charging you a lot of money that you don't know you're getting charged, okay? I mean, they're charging you management fees. They're charging you performance fees, right? And these fees can be huge, but they don't have to disclose them to you. By law, everything I read, they don't have to disclose them to you. That was going to change, but then it got overturned from my understanding, and I'll show you what I'm talking about in just a second. But when you look, like 401ks can charge fees for services such as asset custody, record keeping, investment advice. These fees can be direct or indirect. Indirect fees are often referred to as hidden 401k fees, right? So they're charging you out the wazoo for fees. You just don't know it yet. And also understand, people think these fund managers are supposed to do what's in your best interest. That's not true, right? So like when Obama came in, they're going to try to do this new rule here about the fiduciary rules, what they called it. And because a lot of people think when you give your money to these asset managers and stuff, they got to do what's what's best for you. Well, that just isn't true, right? And so what this is trying to do is, what you have here is asset managers will have, like, say they have two choices. One gives them a bigger commission, right? Which one are they going to choose? Even if the other one they choose doesn't perform as well, but gives them the bigger commission, it's okay for them to do that, right? Because they don't have to do what's in your best interest, so to speak, by the rules, the way it's all written. There's a lot of gray area and stuff. You can sit there and pause this and read this if you like. And of course, what happened was I think they ended up getting it instituted. Trump came in, and again, Wall Street was furious with this, by the way, and said no. And then, of course, they trashed the rule, and then it went to the courts, and the court said, "Yep, nope, we're going to go ahead and keep that rule trashed and everything." And so we're back to they don't have to do what's in your best interest stuff, right? And you're still going to have all these hidden fees you're not going to know about. So, good stuff there. And so I'm sure a lot of people didn't know that, but that's just the truth. Right. And so, like, I'll read this. Currently, if you work with a financial advisor who is a registered broker, he or she only has to recommend investments that are roughly suitable for you. That means if your advisor has the option between two similar mutual funds, but one pays out a higher commission, he or she can put you in that one, even if the other fund has lower fees and would boost your portfolio in the long run. And I don't know if you remember the Wolf on Wall Street. Like, he even did an interview. It was great when he said, these fund managers, they can't stay still, right, and do nothing because, again, when not just us, I'm talking about like when big money, like really people with a lot of money are put their money with these people. Like they're not gonna say, look, just buy the S&P 500 and do nothing. I can do that. Like you got to work up some magic here, right? And so they need to show them like, oh, I'm moving out of Nvidia into this one. I'm moving out of Tesla into this, whatever it is. And then the other thing is, which I don't know if you remember this, I brought up a long time ago, and I just learned this a year ago. Remember, in funds, they like say one fund is called fund, I don't know, BlackRock or whatever, right? And they say, look, in all our funds, you can only have 20% of Apple total, right? And so within those funds, though, there's a bunch of different managers, right? And so say manager A has, let's say, 2%, manager B has 4%. Well, if manager A says, well, I'm done with Apple, I'm selling out, and maybe I'll come back in later, and then manager B picks up that 2%, and the whole 20% allocation is filled up, that manager can't come back in until there's somebody else sells. So a lot of them would just hold it, right? They'll sit there and hold the Apple because they know they sell the Apple, they're not getting it back. If they sell Nvidia, they're not getting it back, right? And that's another reason you will see some of these stocks, they don't drop as much as everybody else does when they go through these major corrections or something, or maybe they stabilize a lot better than other people do, or other stocks do as well. So that's a whole nother thing to it. So yes, I mean, should you try to time the market? No. I mean, there's plenty of things you can do to try to help you out with that. But again, depending on if you're working a full-time job, I mean, just sit there and come up with your plan for dollar cost averaging and doing what you're doing. But there's a reason why the stock market dumps like it does, right? They are dumping too. That's just the way it is. And the reason why they dump, and it kind of makes sense, even if you're sitting there as a passive manager and the market, the market's going to tank, and it's tanking right in front of you, you're best off to sell because they know they can pick that stock up, right, at a cheaper price, and which will make the gains look even better for them, right? So that's a whole other thing. That's why you have quarterly reallocation, window dressing, if you ever heard of that before. That's a real thing. So it happens. And so that's what you want to do. Because remember, you have to present this to people and go, look, pick me. Look at how, look at the stocks on Nvidia. Because remember, at the end of the quarters, they'll dump a lot of their losers and then pick up the winners that look like they did great that quarter, saying, look, we own a whole bunch of Nvidia, even though they just bought a bunch of it right there like a week before the quarter closes, right? And so it's just all these things that go on behind the closed doors. So hopefully that helps out on that one. Now, next one comes from Anthony. He says, Mike, I enjoy your videos. And my question to you is, during an interview with Larry Fink of BlackRock, he told the interviewer that he doesn't see a crash because the feds are planning on spending $1 trillion a year for the next 5 years. Do you see the market continue to go up in 2024 and 2025? Well, first of all, I think you're talking about the federal government, that is. And yes, they're going to spend us into oblivion. But understand, guys, look, this right here is the Fed balance sheet. You want to have some fun? Just look at it, all right? They literally went from $660 billion to $9 trillion, okay, in less than 20 years here. Okay, this is 2002. Right there is 2022 is at the very peak, all right? If you want to have some fun, just pull the S&P up. This represents the market, right? And understand, a lot of people give me grief for this, but when I say the government runs the market, right, the market is totally dependent on this. This is why. And when you measured it, just go back. Well, look, here's from 2003 to 2007, right? Stock market went 44%. Fed balance sheet was pretty much kind of flat, right? Is that 54%? Yeah. And then look what happens here. From 2009, just go to 2020, 11 years, almost 300%. Look at the Fed balance sheet. And then, let's go and throw on what's another 100%, right? When we raise it up and go all the way to $9 trillion, right? I mean, that right there ought to show you, yes, when they inject liquidity, the market loves it. It puts it on steroids, okay? Now, something else you can look at. Just look at the debt. This is the federal government. And you can see, this goes way, you can do this in the trade view yourself, by the way. You can see, stock market's okay right here. And then here comes 2000. And they go, you know what? We're going to go ahead and basically, 5x our debt right here. And take it from, I think it was 8 trillion at that point in time, all the way to 32 trillion. Just look at that trajectory when they decided to do that. And that's after '08. I mean, look at that. That's why I'm telling you. The market is so dependent on our government. And what did you just hear the Fed and the Treasury do together? We're going to pump liquidity into the bond market. Treasury's going to start buying back bonds. The Fed's going to stop. They're going to cut rolling off bonds by half. And it says right there in the thing, to stabilize liquidity in the bond market. The bond market or the stock market reacts off the bond market. The bond market is healthy. Don't matter what else is going on usually. Stock market loves it. They're going to keep going on. It's going to be risk on, right? Bond market gets in trouble. Stock market panics, all right? So that's how it works. And who stabilizes all this? The government, right? They held rates to zero almost for 10 years. They were the biggest buyer of bonds and mortgage-backed securities. We didn't know about that, right? And I was like, what? Who's doing that? And you go, why is this one of the greatest bull runs ever? That's why, okay? And so, what, is the market going to go down? You would think we would have a recession at some point in time to correct all this mess we're in right now, the real estate market and everything else. And that, but that's normal, right? But is the market going to continue to go up? Well, if you look at history and you look at those charts, it's going to go down, but for the most part, it's going to go up and to the right. At least that's what the government wants. And why? Because you imagine all our money's tied up in 401k, pension plans, everything else. What would happen if the market just did a Japan and tanked and didn't come back for, what was it, 40 years? What do you think would happen there? Is that a Great Depression, you think? And you think that they want that? No. Okay, they don't want that at all. So that's hopefully that answers your question. But that's what I keep trying to at least show people. Now, last one here is the easy one. It says, what is the website used to show the earnings coming up with all the logos? I just go to Twitter right here, look up Earnings Whisperer, and there you are, right there. See, and that's the ones that come out for next week right there. And so hopefully all that makes sense and everything, guys. Feel free to add in the comments if you got anything about Apple or hedge funds and pulling back the curtain and whatever the name of that documentary I'm talking about is, if you remember what I'm talking about, because it was really, really eye-opening stuff and kind of disturbing at the same time. So anyway, I'll end up seeing you guys tomorrow to set up the week in tomorrow's videos. We got a boatload of stuff going on this week as well, and it's going to be interesting after Friday's rally how the market handles it, because there's not a whole lot of red folder news, and there's really not any mega cap earnings either to kind of react off of. So it's going to be interesting. So we'll definitely see what footing we're on next week in the market. So please hit the like and subscribe button on your way out, and I'll see you guys tomorrow.